The failure of Silicon Valley Bank on March 10, 2023, came as a shock to most Americans.
This is the second biggest bank failure that's ever happened in the United States.
Many people who work in the banking system and who work at the Federal Reserve didn't expect SVB's collapse. Usually banks, like all companies, fail after a prolonged period of lackluster performance. But SVB, the 16th largest bank in the country, had been steady and extremely profitable only a few months earlier, posting profits of about $1.5 billion in the final quarter of 2022. However, there are numerous instances of banks that appeared to be reliable and successful, but unexpectedly failed in financial history. The demise of Lehman Brothers and Bear Stearns, two prominent investment banks, Countrywide Financial Corp., a subprime mortgage lender, the savings and loan banking crisis in the 1980s, and the complete collapse of the U.S. banking system during the Great Depression didn't unfold in exactly the same way. But they had something in common. A few initial bank failures were caused by an unanticipated shift in economic conditions, which was then followed by widespread panic and severe economic distress. The main distinction this time is that modern technological advancements might have accelerated SVB's demise. The Great Depression. The Great Depression, which lasted from 1929 to 1941, served as a prime example of the harm that bank runs and financial panic can do to the general public. The Roaring Twenties saw a rapid expansion of the American economy, but in early 1929, things started to slow down. The stock market crashed on October 24, 1929, a date known as Black Tuesday. The massive losses investors suffered weakened the economy and led to distress at some banks. Fearing that they would lose all their money, customers began to withdraw their funds from the weaker banks. Those banks, in turn, began to rapidly sell their loans and other assets to pay their depositors. These rapid sales pushed prices down further. As this financial crisis spread, depositors with accounts at nearby banks also began queuing up to withdraw all their money in a quintessential bank run, culminating in the failure of thousands of banks by early 1933. The federal government resorted to closing all banks in the nation for an entire week, not long after President Franklin D. Roosevelt's first inauguration. These failures meant that banks could no longer lend money, which led to more and more problems. The unemployment rate spiked to around 25%, and the economy shrank until the outbreak of World War II. With the Glass-Steagall Act of 1933, the government tightened banking regulations in an effort to prevent a repeat of this disaster. The Federal Deposit Insurance Corporation was established, which insured deposits up to a certain amount, and it forbade commercial banks, which provide services to consumers and small and medium-sized businesses, from engaging in investment banking. That limit has risen sharply over the past 90 years, from $2,500 in 1933 to $250,000 in 2010. The same limit in place today. Savings and loan crisis. The nation's new and improved banking regulations ushered in a period of relative stability in the banking system that lasted about 50 years. However, hundreds of the so-called savings and loan associations, small banks, failed in the 1980s. Savings and loans, also called thrifts, were generally small local banks that mainly made mortgage loans to households and collected deposits from their local communities. In order to combat the high inflation rates that had become entrenched, the Federal Reserve started to raise interest rates very aggressively in 1979. By the early 1980s, Congress began allowing banks to pay market interest rates on depositors' accounts. As a result, savings and loans were required to charge their customers an interest rate that was significantly higher than the interest revenue they had been receiving on the loans they had made in previous years. That imbalance caused many of them to lose money. Even though about 1 in 3 savings and loans failed from around 1986 through 1992, somewhere around 750 banks, most depositors at small S&Ls were protected by the FDIC's then $100,000 insurance limit. Ultimately, resolving that crisis cost taxpayers the equivalent of about $250 billion in today's dollars. Because the savings and loans industry was not directly connected to the big banks of that era, their collapse did not cause runs at the bigger institutions. Nevertheless, the S&L collapse and the government's regulatory response did reduce the supply of credit to the economy. Great Recession. With the economy in a relatively stable state, Congress repealed most of Glass-Steagall in 1999, doing away with rules from the Great Depression that limited the range of activities that banks could undertake. Those changes contributed to what happened when, at the start of a recession that began in December 2007, the entire financial sector suffered a panic. At that time, large banks, freed from the Depression-era restrictions on securities trading, as well as investment banks, hedge funds, and other institutions outside the traditional banking system, had heavily invested in mortgage-backed securities, a kind of bond backed by pooled mortgage payments from lots of homeowners. These bonds were highly profitable amid the housing boom of that era, and they helped many financial institutions reap record profits. But to slow the economy, the Federal Reserve has been raising interest rates since 2004. By 2007, many households with adjustable-rate mortgages could no longer afford to make their larger-than-expected home loan payments. As a result, securities backed by mortgages saw a sharp decline in value as investors feared a wave of mortgage defaults. It was impossible to determine which investment banks held a significant portion of these risky securities. Rather than wait to find out and risk not getting paid, most of the depositors rushed to get their money out by late 2007. This stampede led to cascading failures in 2008 and 2009, and the federal government responded with a series of big bailouts. The government even bailed out General Motors and Chrysler, two of the country's three largest automakers, in December 2008 to keep the industry from going bankrupt. That happened because the major car companies relied on the financial system to provide potential car buyers with credit to purchase or lease new cars. However, after the financial crisis, consumers were unable to get credit to finance or lease new cars. The Great Recession lasted until June 2009. The unemployment rate peaked at around 10%, the highest level since the early 1980s, and stock prices fell by more than 50%. Notably, banks with more than $250 billion in assets were now subject to the strictest regulations, up from $50 billion. Congress made that change in 2018, which made it possible for regional banks like SVB to quickly expand with a lot less regulatory oversight. But still, how could SVB collapse so suddenly and without any warning? Banks take deposits to make loans, but a loan is a long-term contract. Mortgages, for example, can last for 30 years, and deposits can be withdrawn at any time. To reduce their risks, banks can invest in bonds and other securities that they can quickly sell in case they need funds for their customers. In the case of SVB, the bank made significant purchases of U.S. Treasury bonds. Those bonds do not have any default risk, as they are debt issued by the federal government, but their value declines when interest rates rise, as newer bonds pay higher rates compared with the older bonds. SVB purchased a large number of Treasury bonds when rates were almost zero, but since the Fed has been gradually raising rates since March 2022, the yields on new Treasury bonds have increased significantly over the subsequent 12 months. Some depositors became concerned that SVB might not be able to sell these bonds at a high enough price to repay all its customers. Unfortunately for SVB, these depositors were extremely close-knit, with the majority working in startups or the tech industry. They turned to social media, group text messages, and other modern forms of rapid communication to share their fears, which quickly went viral. Many large depositors all rushed at the same time to get their funds out. Unlike what happened nearly a century earlier during the Great Depression, they generally tried to withdraw their money online, without forming chaotic lines at bank branches. However, lines of people could still be seen outside SVB during the days of the bank's collapse. If you like the video, like and subscribe to our channel,